Welcome to the most interesting part of the video, that is the technical analysis. In this series, you might have studied about the graph, the patterns, the candlestick patterns, but technical indicators is one of the most important and one of the most interesting topic in technical analysis. Just by knowing the technical indicators, you can easily predict the movement of the company, the movement of the graph, in which direction the graph is going to go, whether the company is going to go high, low, so all that. So technical indicators are the tools which are designed to help us study the movement of the graph and predict the most probable direction in which the company is going to move. So by the use of technical indicators, you can know the condition of the market. So they are most important in intraday trading and very useful, very useful. So just go ahead with full interest. Watch the video without any distraction, and this is very important if you want to do intraday trading or any kind of trading, and it will help you very much. So you must watch the video without skipping it and focus on every part of the information that is being taught to you now. So just listen now carefully. So first thing in indicators is the moving average indicator. So there are different types of indicators which I'm going to be teaching you. In among those, moving average is the most popular one because and most important too. So average, all of you might be knowing what an average is. Average means addition of different things and it is divided by how many things are adding. So it is average. Generally there will be, like, you have 5 numbers. So the average of the 5 numbers is the number which is closest to all the 5 numbers. That is what average means, right? In mathematics you might have studied what is average. So moving average, it is also known as MA, SMA or DMA. MA means moving average. SMA means simple moving average. It is also called simple moving average, and it's also called DMA. DMA means daily moving average. So now what is this? What is the moving average? It is the average of the candlesticks. So because we will be using the indicators on the charts, on the chart we will be using the indicator. So there will be the candlestick chart, right? I told you will be using the candlestick. So on the chart you will be using an indicator. So it will tell you more about the chart. So moving average is the average of the candlesticks and it acts as a support and resistance. So I told you last time, you can draw an imaginary line from the base and from the high, but moving average, it also acts as an, using this indicator, it generally acts as an support and resistance because it is the average of all the candlesticks. You can use this indicator, the moving average, you can use it as a support and resistance, which I'm going to be showing you now soon. So this is from my upstox. I have applied the indicator. So the red line is the moving average, as you can see. The red line is a moving average. In moving average, you have different period because average, right? Average has to be taken among different numbers. How many numbers you are taking average for? That is called the moving average of a particular number. So here, this is the 12 period moving average. What is 12 moving average? 12 MA means the average is taken for 12 candles. So if you look closely, there are many candles, right? So if you look at the 12 candles, the recent 12 candles, the average of the 12 candles is being plotted. So you keep plotting, you draw a graph for the averages. So 12 candles average is taken and plotted. That is called the 12 moving average. And 50 moving average, if you draw an average for 50 candles, if you take 50 candlestick charts and if you take 50 candles and draw an average for the 50 candles, it is called the 50 candle moving average. And similarly, you have 200 moving average, which is the 200 candles moving average. So what happens if it is a 12 moving average? Obviously, the value will be nearer to your recent candle, right? So whatever is the price, the average will be nearer. And if it is 200 period, obviously it will be far because the price will vary very highly. So the line will be drawn a little bit far, which I'm going to show you. But you can see this is the 12 candle moving average and the average is moving like this. It is smoother. It looks a little bit smoother than the candles which move haphazardly because it is an average, right? So now you can see here it acts as a resistance. Let me show you. I told you moving averages act like an support and resistance, right? So you can look here. Here it is acting as a resistance. You can see the candles are not going above this. Here so many candles. So here as soon as the moving average broke it, as soon as the candle started acting as a resistance to 3 candles, you could have sold because you can see, you can take it as a resistance. You can you can sell at the resistance, and later after it broke the average, see, a green candle has crossed the average, right? It has gone above the 12 period moving average. So now the average is acting like a resistance. So this indicator acts as a support. From here you can see it is not going below the 12 period moving average, always it is above. So if you would have bought at this point, because it has broken, because the average has been broken, so it will act as a support. Because if the resistance line, if the candle crosses the resistance line, the resistance becomes the support. So here the resistance is becoming the support, and then you could have bought it here. Then you can see the company has kept on moving above until it breaks the moving average. So now here, see, still here the chart has gone up. So if you would have bought here, this could have been your buying point. You could have easily bought here because the uh, resistance has been broken. The moving average acted as a resistance till here, but immediately it was broken. So it started acting as a support. If you would have bought here, it kept increasing from here. It kept acting as a support and the company price kept increasing. You would have made so much profit. 2 days, the Nifty kept on moving up. Now again it has broken the moving average, so the company kept falling. So it broke the support, right? This moving average acted as a support. So here when it broke, you could have sold here. So your profit was from here to here. You clearly made a profit of so much. So this is called the moving average. It is very beneficial, as you can see. Now after it has broken it down, downward, it has gone below it, the company kept going down. So you could have sold the company here. So moving average acts as a support and resistance. I told you support and resistance is an imaginary line what you used to draw. But here the moving average helps you easily finding what the support and resistance can be. Now let me show you a 200 period moving average which is larger. Here you can see the moving average is nearer to the candles. But in 200 period it will be far. So when is it good? It is good for long term investment. If you're planning of doing long term investment for a longer period of time, if the 200 period moving average is being broken, then you can easily buy the company. If it's breaking it upward, you can buy because it will act as a support and it will not touch. See, it's very away from the 200 period moving average. The candles will always be away. So here it has gone above. After it goes above the 200 period moving average, you can buy and it will keep going up. Here it has gone down like that. But this happens very rarely. Very rarely a company breaks 200 period moving average. So see, the 200 period moving average will generally be straighter because it is 200 candles average. So it will be more away and it will be straighter. This is closer. So the smaller the moving average is, so if it is a moving average of 12 period, it will be nearer to the candles. If it is a moving average of 40 period, it will be a little bit away. If it is 30 period, 20 period, so you can assign in the upstox itself, in the platform, you have an option. So whatever platform you might be using, you will have an option to adjust the moving average and then you can see. So moving average is very much beneficial. So here the yellow line, if it crosses the red line below, the company is expected to go down. Now as you can see, here it has gone down. The yellow line has crossed the red line below. Yellow line is the 10 period moving average and red line is the 20 period moving average. So see, you can continuously see a downward movement. You can easily predict the movement of the company. See, you can look at the price moving in real time. So immediately after the yellow line had crossed the red line, the price had kept on going down. You can see 4 candles have gone below. So if the yellow 10 period moving average crosses upward, the 20 period, if the yellow line is crossing upward, here the yellow line is the 10 period. You can adjust the color. So I have kept yellow and red for 20 period. So if the yellow line is crossing upward, see the price is going upward. So you can easily predict the movement of the price. See here, after this prediction, I told you yellow line has crossed the red line downward. So the company will fall down. See, there is a continuous downward movement. You can clearly see that there is a continuous downward movement. So it is so simple to predict the movement of the company. You don't need much knowledge. See, the price has continuously kept falling down. So that's it for the simple moving average, and you can also use it as a support and resistance, as I told you. So if you look at the red line, the 20 period moving average, see, it acted as a support. Continuously it was acting as a support, and here it has broken the support, so it will act as a resistance. So the price will not go above that. So that is what happens. you can either use it as a support and resistance or you can look at the crossover. So there are different types of crossover. There's something called as golden crossover. In golden crossover, what happens, you use a 200 period moving average. Here, just like I have used 10 period and 20 period moving average, you use a 200 period moving average and a 40 period moving average. So that is called the golden crossover. If the crossover happens with a 200 period moving average, because it is very rare that a company crosses a 200 period moving average. So there is a crossover between 200 period moving average. That is called a golden crossover, and you can easily make a buying and selling decision for long term. It is very good. Next, you have the double crossover. That is, this is called the double crossover. Here you can make use of the 10 period, 20 period moving averages, and you can easily predict the moment. The next one, exponential moving average. Now, what is the difference between the moving average, simple moving average, and the exponential moving average? I told you, simple moving average is the average of the 20 candles, 30 candles, whatever the period you assign. So that is the simple moving average. Now, what is actually exponential moving average? Exponential moving average takes into account the recent price trend. So whatever is the latest price, that will be given more priority. So this is the latest price, right? This will be given more priority than the prices before it. So if you're taking 12 period moving average, the last price will have more priority than the previous price. In the simple moving average, all the candles were given similar priority. But in the exponential moving average, the latest price, the current price will be given more priority as compared to the previous, and that is also the average. So generally, almost all indicators are made on the basis of moving average. That is why the moving average is one of the most important technical indicators used. So you can easily buy, you can make a buying decision easily. You could have made so much profit here. You could have made profit here if you would have bought when this was broken. Then exponential moving average, you can easily use the same method. It can be used as a support and resistance. But the latest candle is taken into account. So it is much. See, this is the exponential moving average, that is the EMA. You can clearly see that it acts as a support and resistance. Here it is behaving as a support. Until here it was acting like a resistance. Again support. See, continuously it acted as a support. And here resistance. So again, EMA can be used as a support and resistance. You can look, it is just like a simple moving average. It is used in same way, but it is very good for short-term trading. That is why intraday EMA is one of the best indicators to use. You have to just use it like a support and resistance, just like how you use the simple moving average. It is called the exponential moving average, but it gives more priority to the recent price trend. Now you have Bollinger Band. Now what is Bollinger Band? So it was developed by a person called John Bollinger. There was a person called John Bollinger who made Bollinger Band. It defines the upper and lower price range. It is just like a moving average indicator. It is made from that, but it shows you the support. I told you support and resistance. Moving average acts as a support and resistance, right? So here you can easily see the upper price and lower price range. It will show you the highest price and the lowest price range. It will show you it will define the upper and lower price range. So you can easily make a buying and selling decision. So at the lowest point you can buy, at the highest point you can sell. So Bollinger Bands is one of the most important indicator. It tells you where to put your stop loss also. You can easily define a stop loss with the help of this. So Bollinger Band gives you the upper and lower price range. It has upper, middle and lower price band. So the line which you will be seeing now further, I will be showing you, the line will be called as a band. And it will give you the upper, middle and lower price band. It is also called envelope. Upper envelope, lower envelope, and it is simple moving average and standard deviation. So in this, we take into account simple moving average and standard deviation. So the upper line and the lower line are nothing but standard deviation of the moving average. So Bollinger Band is nothing but moving average, but it is a standard deviation. It has standard deviation. You might have studied what standard deviation is in your mathematics. You don't have to go into so much detail, but see, it shows you the volatility, the Bollinger Band. It shows you the standard deviation. So for example, 65% chances of the price to remain in the band. If you keep the standard deviation as 1 for a Bollinger Band, you have to set the standard deviation. If the standard deviation is 1, then the bands will be closer. So there is 1%, 65% chance for the price to remain in the band. And if you keep the standard deviation as 2, so the band will go away, right? So it will be thicker. So then the 95% chances. There are 95% chances for your price to remain only in the band. It will not go away. And if the standard deviation is 3, there is 99% chances that your price will be only within the band. It cannot go away from the band. So let me show you. This is the Bollinger Band. You can clearly see the price moves within this tunnel kind of structure. You can see. So this is the lower band or the lower envelope. This is the upper band or the upper envelope. This is the middle band or the middle envelope. Now you can see the price keeps moving within this. So you can take this as a support, you can take it as a resistance. The middle line is just the average. Now, or how you can use this band to make a buying or selling decision. So there are places where the band breaks. See, the band moves like this, right? So here the tunnel had been broken. See, it became thin. So there are places where the pipe will become thin. If you consider this like a pipe, the pipe has become thin here, right? Then it has been broken upward. See, there are candles which go upward. So the company is expected to go up. So how will you make a buying decision? How I use Bollinger Band basically is, so we consider the band as a pipe. There are places where the pipe becomes shrink. The pipe shrinks. It becomes smaller. So see here you can see. Compared to other places, here it is thick, here it is thick, here it is shrink. So the area where the price band has been broken, it has been shrinked, and the direction in which the band is being broken, if it has been broken upward, so the company is expected to go up. So you can easily make a buying decision. You can buy the company at this point. You could have bought here and you can see the company kept on moving up. You can easily keep a stop loss here or this one. You can keep a stop loss as a lower band. So Bollinger Band is one of the most important bands in making a buying and selling decision. It is very much helpful. This is the Bollinger Band. You can look at the Bollinger Band. So the price movement is between the Bollinger Band. Almost always the price remains between the Bollinger Band. You can clearly see. So the place where the band becomes short, let me show you. So here the band has been broken. So this is called a pipe. I told it looks like a pipe, but here the pipe became shortened and the price has been broken downward in the pipe. So from there the price has gone down. Continuously there was a downward movement. So same way you use the Bollinger Band by looking at the breaks in the pipe. So if Bollinger Band is considered like a pipe, the place where the pipe is being broken, see here the price has been broken upward. The pipe had got shortened here and the price was broken upward. So continuously there was an upward trend. So you can easily make a buying and selling decision just by looking at the Bollinger Band. So this is the Bollinger Band. And the price, because I have kept 20, so the price generally remains inside. It comes out too, but see, the pipe had become shortened. The price had gone downward. The pipe has been broken downward. This is the pipe which got shortened. And from here, the price had gone down. So after you look at this candle, it was a deciding factor that the price has gone outside the broken pipe and downward. So continuous downward movement is there. So you could have easily sold. So you can easily make your buying and selling decision based on the Bollinger Band. It is a very good indicator to be used. You can see, you can see live how the price is moving. See, the price remains in the Bollinger Band. It is very difficult for the price to cross the Bollinger Band. In very rare cases, the price crosses the Bollinger Band, and if it crosses and if the pipe is broken, the moment you can easily make a buying and selling decision. See, you can look, it keeps moving within the pipe. So if that is a pipe, the price goes within that. So you can easily decide a support and resistance. The lower one can be considered as a resistance. The upper one can be considered as the lower one can be considered as a support, and the upper one can be considered as the resistance, moving within the band. So this is the Bollinger Band. You can try using. All these indicators must be used for you to understand them and for you to learn how to use them. Until you try it and start trading, you cannot learn. So just first thing is just create an upstox account or the demat account from the description, and then start. Take the first step, that is starting. So use. Initially you might not be able to use. See, this was a resistance. You could have sold here. One candle. Immediately the candle has gone down. Even if you make the profit of one candle in the live markets, see, because this acted as a resistance, the price kept moving down. It doesn't cross it. See, now from here, it is generally expected to go upward. See, it has fallen down. So it's very clear. You can clearly see. Because now let's go to Ishimoku cloud. This is one of the most complicated indicators which people find very difficult in understanding generally, because it is difficult to understand. It looks complicated. There are many terms which come in the Ishimoku cloud. It is called the Ishimoku cloud. Okay, so the name Ishimoku cloud came from Ishimoku Kinko Heyo, who's a Japanese person who created this band. This indicator has so many information. It has the simple moving average, demand, supply, everything will be coming into account in this indicator. That's why it looks complicated. It gives you a lot of information. So Ishimoku cloud was given by Ishimoku Kinko Heyo, one look equilibrium chart, because it has almost all the information. So the name Ishimoku Kinko Heyo, which means one look equilibrium chart. Not the name of the person was in this. Ishimoku Kinko Heyo means one look equilibrium chart. It means at one look, at one glance, you can find the equilibrium. You can find almost a lot of information. So in this, we have conversion line, we have baseline, we have lagging span. So there are three main lines. If you look, you will be having three different types of line. Conversion line is a short term trend. So again, it is the average, 9 period moving average, which is being smoothened. So you have short term trend, long mid term trend, which is 26 period, 26 candles trend it will be showing you, and long term trend, lagging span. So you have conversion span, baseline, lagging span, conversion line, baseline, and the lagging span. These three lines will be telling you a lot of information. And then you have the cloud. Cloud has the leading span 1 and leading span 2. So cloud is made up of two lines, which has the leading span 1 and the leading span 2. Do not trade when the price is between the cloud. So when the price lies between the crowd, you shouldn't make the buying decision. So I told you, let me show you. This is the Ishimoku cloud. It looks very complicated, right? Yes, it looks very complicated. Let me show you. So the nearer one is the first one. This is the second one. The first one, that is the 6 period, right? I showed you 9 period conversion line. So this blue line is the conversion line. Blue line which you see here is the conversion line. Red line that you see here, this red line is the which line? That is the baseline. See, you can see the baseline. It is below. And then you have the upper line, which if it is below, you will be selling the company, and if it is above, you will be making only the buying. So if you want to buy, see this line is above. This yellow line, which is the lagging span, right? This is above. If it is above, you will be buying. You have to only buy when this line is above, and you have to sell when this line is below. See, you can see here, when this line was above, the market was bullish, and when this line was below, the market was bearish, like that. And then these, so here you can see, let me show you. When the blue line breaks the red line upward, see, the blue line broke the red line upward, the market became bullish. So whenever you want to make the buying decision, when you want to buy, you have to look at the blue line breaking the red line. When the blue line breaks the red line upward, the company is expected to go up. And when the blue line breaks, see, you can see here, the blue line has broken the red line downward, so the market became bearish. It kept falling down. So this is what is called as the Ishimoku cloud. It is not very difficult, and this is the cloud. When the price lies between the cloud, you should never trade when the price is between. See, here the price is between, you shouldn't have bought here. Here the price is between the cloud, you shouldn't buy or sell here. So otherwise, you have to do the trading when it is away from the cloud, when it is away from the cloud, when it is away from the cloud. When this lagging span is down, you have to sell, and when the lagging span is up, you have to buy. So you should buy only when you find that this line, the lagging span is below. So that is what it has. So you studied about, it has the baseline, conversion line, lagging span. Based on these, when the conversion line is breaking the baseline upward, you have to buy, and when the conversion line is breaking the baseline downward, you have to sell. So it's easy. Next, you have the alligator. Alligator is 3 simple moving average. Alligator is an indicator which is made up of 3 simple moving average. It has the upper lip. It looks like an alligator. You might have seen a crocodile, right? The alligator. So the upper is the green lip, blue is the jaw, and the middle teeth or the tongue, you can call it, it is red color. So the lip is green color, the teeth is red color, the jaw is blue color. The lip, that is the 5 period moving average, and 8 period moving average, and the 13. So it consists of 5 period moving average, 8 period moving average, and 13 period moving average. 5 period moving average means the moving average of 5 candles, and it is smoothened over 3 bars. And next is the 8 period moving average, which consists of 8 candles, average of 8 candles, and smoothened by 5 bars. And 13 period moving average, which is the 13 candles average and smoothened by 3 bars. You don't have to focus much on the definition. You just need to know that it is average of 5 candles. And if the lip crosses downward, so the lip is the 5 period moving average. If the 5 period moving average crosses downward, it's going to go downtrend. If the lip crosses upward, it's going to be uptrend. And gap shows the strength of the trend. If the gap is more, the trend is more, and less, the trend is less, like that. So you can see here, the lip has crossed upward, right? You can see the lip has broken upward. The red line is going upward, so the trend is up. So the distance between these is more, so the uptrend is strong. Here the green, sorry, not the lip, the green candle. You can see the green candle, the up one, upper lip has gone up. The green candle, the green line that you can see is going upward. So the trend is upward. It has broken both and the distance has increased. So it's strong uptrend. Here the green line has gone down. So it is downtrend. You can see the green line is breaking the two below. Blue and red line is being broken here. You can see. So the green line is going down. So that it's downtrend. So you can see here. Here there's a crossover. So from here you can make your selling decision. Again the green line has gone upward. So it is uptrend. So that is how you can decide. By using the alligator, you can easily make your decision whether the company is going to go up or alligator. As I told you, alligator has the upper lip and the tongue or the teeth and the lower jaw. So you can look. The upper is called the green. So the green is generally the upper. So upper lip, see here it's clear. Green is the upper, red is the tongue or the teeth, and down is the lower jaw. So when the upper jaw crosses the other two, the tongue and the lower jaw, the upper green one. If the green one crosses the red one and the blue one downward, the company goes down. See, it's clear. The green one has gone down. So there is a continuous downward movement. See, the company has continuously gone down, and the distance of all the three decides how strong the trend is going to be. So here you can look. The red one, the green one, sorry, the green one has crossed the two upward, and then the gap has increased. So you can see from here there is a continuous upward movement. So again, still here you could have bought it, and here you could have sold it. So from here it started to go down. So you can see the green one again crossed upward. You can just look, see, the green one has gone downward, so there is a downward movement. So just look at the green one, the green indicator, the green line. So the green line has gone upward, see, so there will be an upward movement. If the green one crosses the other two upward, there will be an upward movement. So it's easy to predict. See, now the company is going upward. So because the green one crossing the other two, in which direction the green one, that is the upper lip, crosses the other two, shows the direction of the company. So the green one has gone upward. So see, look, continuously the price is moving up, and the strength, because the gap is more, it is more strong enough. It will go up. See. Next, you have the relative strength indicator. It shows the overbought and sold. Relative, it is also called the RSI. RSI means relative strength indicator. It shows the strength of the market. If the buyers are strong or the sellers are strong. So this is the relative strength indicator. It is present below. You can see here. So if it touches up, it means it is overbought. Overbought. Lot of people have bought it. And if it is touching below, it means it is oversold. So at the overbought, you have to sell the company. So let me show you. At this point, it is overbought, right? So here, downtrend started. Once the company touched here, it started moving down. Here again, it is down. So it has touched this below 30. This is called 30 and this is called 80 line. There are two lines. So when it has gone below to the oversold, see, you can see the graph going down, 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 down. Then it has touched the below line here. Then it starts to go up. So when it touches the oversold zone, it will start going high. When it touches the overbought zone, you have to sell. So you must sell immediately. You can see here, it is touching the upper line. So you must immediately sell. The company started falling. And once when it goes to the lowest point, you must buy. So immediately the company started going high. You can see. So you can easily make a buying and selling decision even based on the relative strength, the RSI indicator. And after it touches the overbought, that is 70 is the overbought. So you can see here, after that it keeps falling. The price keeps falling down. And when it is the oversold zone, when it reaches here, you can see on the RSI indicator, the price starts to go up. So this is called the RSI indicator. See, the price keeps moving between the RSI. That is between the overbought and the oversold zone. 30 is generally the sold zone and 70 is the overbought zone. So the price moves between that. So it is easy for you to predict. Once it touches the top, you can sell it, and once it touches the bottom, you can buy it. So this is how you use the RSI indicator. It is one of the most simple indicators to use. These are the indicators. And with the help of indicators, you can easily predict the movement of the company. You can easily guess whether the price of the company will go high and low. So today we studied about the simple moving average, where you have to, the simple moving average acts as a support and the resistance. You can use the simple moving average as a support and the resistance to make a buying and selling decision. And next, we studied about the exponential moving average, which can be used same way as the simple moving average, but more accurate. And for intraday trading, it is the best. Exponential moving average is best for intraday trading because it takes the recent price action. And next, we studied about the Ishimoku cloud. We studied about the Bollinger band. Bollinger band shows the upper price and the lower price, and you can use it to make a buying decision. If the pipe the pipe is broken upward, you can buy, and if the price is broken downward, when the pipe becomes shorter and then broken downward, you have to sell. And next to study about the alligator. Alligator has the upper lip, which is green color, the tongue, and the jaw lower part. So when the upper lip breaks both the lines downward, the company is expected to go down, and when the upper lip crosses upward, you have to immediately buy. There will be an uptrend. And next we studied about the last one, that is the RSI indicator. It shows the relative strength of the market, whether the market is overbought or oversold. So when a lot of people have bought it, it will start falling, because then people will start selling. So it cannot go because the demand has increased very much, then it will start falling. So like that, you can look at the overbought and oversold zone, because like I told you, you have a limited quantity of rice. Once all the rice get bought, then people will start selling it, right? Because all the rice is bought, and that is the maximum it can go. So same way, RSI shows you the maximum price and the maximum. So you can buy when it is over, you can sell when it is overbought, and you can buy when it is oversold. When everybody has sold it, you can buy, because the price will be cheap at that point of time. So this is what is called the indicator. They play a very important role in trading. And now you might have learned. Now you can start trading. If immediately open your demat account from the description, if you have realized the advantage of trading and how easy it is, how you might have seen that you can easily predict the moment. So if you're confident, initially you might lose a few money, you might hit a stop loss, but slowly, by following the indicators, when you learn to understand the indicator, and when you learn to make use of whatever knowledge I have given you in the technical analysis course, you can easily start making profits. So later I will show you live trading in the market, but that's it for the knowledge. Whatever knowledge was needed, the technical analysis has been covered completely. Now you know the technical analysis course has been over. Later I will be teaching you fundamental analysis if you want to do long-term investment. So if anybody is interested in long-term, they can go to my fundamental analysis course, which I will be making it available soon. So thank you very much, and do like and share the video, and also subscribe, and comment down below that how I can improve my videos further, what I can do to make the videos interesting. You can tell me your feedback in the comment, and thank you very much. Immediately open your demat account. Thank you.